at least when we mention stocks right to the word go, look at that. And it's now settled about 6.5%, 7% up. So 519 or so is where Shakti pumps it. Sonia.
A couple of more stocks, right? M&M Financial continues to be under pressure. So now that stock is down almost 15% for the month and down almost about 1% today. Samvardhan Motherson is trending a tad bit in the red. Ashok Leyland as well. A little bit of profit taking is what you're seeing on Ashok Leyland. But largely, you'd have to say the market is holding up. The Nifty is up 110 points. It's SBI Cards that's reacting to its good data that's come out for the month of August. And apart from that, the new listing Harsha Engineering that had a very strong run yesterday, it's now up almost 3.5%. So day two is also looking pretty good over there. But Nilesh Shah, the MD and CEO at Envision Capital, joins us now to talk more about the market as well as what he sees as the way forward. Nilesh, hi, good morning. Before anything, I have to ask you your view on the IT space because it's been a crunching bear market over there, especially for the large cap IT names, and seems like no respite on the horizon. What would you do at a time like this? Would you look for opportunities or do you stay away?
No, clearly the IT sector has faced the brunt. Margins, which of course were at a record high right through the calendar year 21 and early part of calendar year 22, are kind of moderating. But having said that, the valuations, the P multiples have become a lot more reasonable. And our view is essentially that don't expect the margins to further deteriorate from the current levels. The demand environment still is pretty much intact. We've not heard of any IT companies talking of any slowdown in terms of demand. Even if we reflect back to the past crises which markets like the United States or Europe faced, even in that kind of an environment, the demand for Indian IT services companies was pretty much non-discretionary. So to that extent, we now see an environment where the demand is intact. The margins perhaps have moderated or have bottomed out, I'd say, and valuations have become a lot more reasonable. So from here onwards, we don't expect the IT sector to be an underperformer. It has been an underperformer right through this entire calendar year, but from here on, don't expect the IT stocks or the IT sector to fall more than the market. So if the markets were to fall 10%, maybe yes, the IT stocks will also fall 10%. But don't expect it to kind of be an underperformer from here on. And I think it's a good time to start accumulating a lot of high quality, growth-oriented IT stocks.
Okay. Nilesh, hi, good morning. What about the market overall, Nilesh? Because, we have the US, which is now testing its June lows. Our market, of course, has outperformed by some margin, actually. Do you think this outperformance sustains?
Yes, the outperformance is likely to sustain, Anuj. Maybe it's quite possible that some of this outperformance will get shedded in sooner rather than later. It's quite possible given the kind of outperformance we've had, but I still expect India to be an outperformer in context of what's happening globally. Just look at some of the growth estimates. The fact that GDP growth is still expected to be 6 to 7%. Inflation is going to be still subpar what we are seeing in developed markets. And at about 6 to 7%, we're still talking of nominal GDP growth of about 12 to 13%. And with margins now expected to improve because of the way commodity prices have fallen or the raw material and input prices have fallen, expect margins to probably kind of hold up or even get better over the next 2 to 3 quarters. So overall, the way we look at India is that we see a nominal GDP growth of about 12 to 13% and maybe an earnings growth which is in probably the high teens. Now, that's something which not too many markets can really kind of, in a way, talk about at this stage. So I think on the back of all of that and the way our macros are getting managed, the way policy initiatives are being undertaken, it's quite likely that India will continue its round of outperformance versus rest of the world.
Nilesh, sorry, just to kind of pick up the point on IT, there are some who believe that growth rates for IT services will be back to pre-COVID levels. So multiples why should multiples be significantly higher than pre-COVID levels? How do you respond to that?
So it's going to be different companies or different pockets of the IT services space will probably have different kind of growth prospects. So yes, of course, the top 2 or 3 IT companies, which of course are dealing with a very large base, will probably see growth rates of about maybe 10 to 12%, which still I think is pretty good in an environment like this. But there are going to be several pockets which are there in the tier 2 IT companies, which probably are dealing with areas like ER&D or mobility or design-led services. These are businesses which will still kind of grow at probably rates which are higher than the pre-COVID rates, which means that their growth rates could comfortably be at about 15 to 20%. So clearly, I think in that kind of an environment, and even when the world is talking of a recession, if you can still have revenue growth of maybe 15 to 20% and can sustain earnings growth as well at 15, 20%, I think the case for maybe in some of them to enjoy P multiples, which are probably even higher than where they were at pre-COVID level, I still think that would continue to be the case, because the bottom line is that these are companies which still generate huge amount of cash flows, they are capital efficient, and the runway of growth for them is still incredibly long and large. So you're going to see these kind of some of these pockets getting still continue to rewarded very well. And mind you, some of these stocks have come off by 30, 40, 50%. To me, that seems to be an opportunity in the current kind of environment of a bit of pessimism there.
Okay. Well, one sector that is seeing a big pickup in demand and has coming out of a multi-year bear market is autos. Even as we speak, M&M, Eicher Motors, Maruti saw over 57,000 units of bookings for their new Grand Vitara. Is this a space that one can still get into, and how do the valuations look now?
Oh, absolutely. It's still kind of autos continues to be one of those, opportunities of growth from an India context. I think combined basis autos and auto components is a space we've been pretty optimistic about. We've been owning it in our portfolios and continue to like this space. Of course, some of them have, of course, run up quite a bit, especially in the auto ang space. So, of course, you could probably, take some profits off the table. But otherwise, it looks that for the next 2 to 3 years, Indian autos and auto components put together are kind of going to be on a comeback trail. Some of it is priced in, but I still believe that the margins are going to go a lot better. Some of the past challenges like chip shortages or higher steel prices, higher raw material prices are probably now behind them. So I think we're getting into an environment where we could probably see a double-digit growth in demand backed by margin expansion, which I think is pretty good in terms of earnings growth from a 2 to 3 year perspective.
Okay. Nilesh, the other space which has done well is specialty chemicals. Do you like this space? Even after the run, and any specific names that come to mind?
It still looks good. Specialty chemicals, yes, has run up quite a bit. And one will have to actually see how the demand environment is going to really play out globally. If we are talking of some kind of a recession globally, or demand is going to fall off, one will have to really see how it impacts specialty chemicals. So it's going to be a bit of testing times, but some of the specialty chemical companies do have long-term contracts. So there's a very strong visibility for maybe a few years from now. So to that extent, I still think that specialty chemicals is a good space to kind of look upon. And I probably believe that all the frontline names out there on specialty chemicals still kind of continue to be good investment opportunities.
Any big trigger that you see here on which could lead to, EPS getting upgraded for the Nifty? I mean, we've been talking about how corporate profitability, profit to GDP ratio is now at a decadal high. So a lot of brokerages have sort of raised their EPS estimates for the full year for the Nifty. Would you do the same, and any other triggers that could lead to that?
Well, the case for EPS upgrades, I still think continues. What's really been surprising is the way the prices of commodities have fallen off. Even this morning I was reading that palm oil prices are probably at 1 year low or 2 year low. I mean, just about 3-4 months back, we were talking about how palm oil prices are basically kind of raging. But clearly the fall has been, in fact, even much more sharper than expected. So this, I think, is extremely good news, especially for some of the consumer-facing companies. We talked about autos. We just kind of alluded to IT, where basically the margins perhaps seem to have already bottomed out. So I think on the whole, it looks to be a case that, driven by essentially falling input prices, margins are set to expand, which makes the case for EPS upgrades going forward for the Nifty basket and for companies in general. So I still continue to believe that maybe commodity prices can still fall a lot more than what they have fallen already. And that could be a hugely positive surprise for India and Indian companies.